Part 3 for Chapter 10, we're going to cover non-interest purchases, software development, and IR&D expenditures. Deferred payment contracts. Rule: book at present value of the consideration exchanged between the parties at the time of the exchange. So our example, Danny Company purchased equipment on January 1st by signing an $800,000 5-year zero interest-bearing note when the prevailing rate is 12%. The company will pay off the note in 5 installments, each at the end of each year. We want to do the journal entry for the purchase for the first and second year payments and the depreciation. Step 1. Since this is an annuity with equal payments at the end of each period, we will use the present value of an annuity table to determine the present value of the 5 payments of $160,000 when n equals 5 and I equals 12. So we're going to go to our present value table. Now again, we know that n equals 5 and I equals 12, so we're first going to go down to the 5th row and we're going to go across. And that's going to give us the factor we're going to use to figure out the present value of $160,000 paid at the end of each of 5 years. So step 2, we're going to take that factor times the $160,000, and that tells us the present value of those payments is $576,765, which means the difference between that and the $800,000 is discount on note or interest expense. So first, we know the equipment is going to go in at the net present value of the payments, and then the discount is going to be the difference between the note and the amount that is going to be treated for the equipment. Notes payable is going to be $800,000. Now, I like to do an amortization table because it kind of helps you figure out what the payments and the interest is. Because what you have to do is every time you make a payment, part of that is also interest. So year 1, we start with $576, which is the net present value of the notes on the book, which would be the notes payable minus the discount. So for year 1, we take $160,000 minus $69,212, which is the interest expense, $576,765 times 12%. And then we have $160 minus $69,212. That gives us a reduction of the principal. And now we end up with the net book value of our note of $485,977. So our journal entry looks like this. The notes payable would be reduced by $160. Interest expense would be booked by $69,212, and cash would be $160. And discount on notes would be reduced by $69,212. Now let's look at the next year. For year 2, we would take now we have a net book value of $485,977 times 12 gives us the portion that's interest expense. We then subtract that out. It gives us a reduction of the principal. And now we're going to end up with our new net book value, which is the notes payable minus the discount. Now we can do our journal. Notes payable again would be $160. Our interest expense would be our $58,317. Our cash is $160, and again we reduce our discount on note. Now, what is the depreciation at the end of the first year, assuming no salvage value and using the straight line method? It would be $57,677, which would be our $576,765 divided by 10 years. And that would conclude how you record a purchase when you use a discounted note. Now we're going to go to R&D expenditures. Assets purchased for a single R&D project are costed or expensed in the year that they're purchased. Assets purchased for more than a single R&D project are capitalized and depreciated or amortized of the asset included as R&D expense in the current and future period. But it would be depreciated, not, I don't know why they say amortized, but okay, I would depreciate it. So When we do research and development, we try to categorize the costs into two areas. First, we have what's research. That's the planned search or critical investigation to discover new knowledge that helps developing a new product or service or a new process or technique or improving an existing product or processes. Now, the reason that we expense this portion is because a lot of times when we start, we don't know what we're going to end up with. There's a lot of uncertainty. Development is translation of research findings into a plan or design for a new product or process or improving existing product or processes, whether intended for sale or use. Now, under GAAP, both research and development costs are expensed when incurred. Legal and filing fees are capitalized as intangible assets. Under the international standard, only research costs are expensed. Both the development costs incurred after feasibility is established and the legal and filing fees are capitalized as intangible assets. So let's take a look at our example. In this case right here, these are the costs that were incurred. We had salaries, material and other costs for basic research. That we then have development costs. We have legal and filing fees, and we also have a piece of equipment that's going to be used on multiple products. So we add those up, and total research is $5 million. How should the expenditures be accounted for under GAAP? So we would take the research costs and the development costs and the depreciation for a quarter of the $100,000, because it's good for 4 years, and we would expense $6,825,000. We would have an intangible asset of $50,000, which would be our legal and filing fees, and then the equipment would be capitalized as $100,000. Now, what does this look like under international standard? We would only expense the $5 million and the $25,000 depreciation. The development and legal and filing fees would be an intangible asset. Now, the next thing we're going to look at is software development, which gets special treatment. Costs incurred up to technological feasibility are expensed. From technological feasibility to the release to the public are capitalized as an intangible asset. It is then amortized using one of the following methods, and you end up using whichever one gives you the highest amount. First, we have percentage of revenue, which would be the current revenue divided by the total anticipated revenue to get a percentage, and you're going to take that times software development costs that have been capitalized, which gives you amortization expense. Or you can just straight line it, which would be the software development costs divided by the useful life. So now let's take a look at an example. On September 30th, Mike Software began developing a software program to shield personal computers from malware. Technological feasibility was established on February 28th, and the program was available for release on April 30th. The development costs that were incurred during each of these periods is listed. Now, Mike Software expects a useful life of 4 years for the software and the total revenue of $6 million during this time. During 2019, revenue of $2.4 million was recognized. What are the journals for 2018 and 2019? First, we would expense the research costs, and we would call it research and development, and that would be expensed up to technological feasibility. Now, once they reach technological feasibility, first of all, before that, we would expense any additional costs for research before technological feasibility, and then we would capitalize the costs incurred after that. So it would look like this for our journal entry. Now we get to amortize our software development costs. Now we have two methods. We're going to do both to see which gives us a higher amortization expense. We get 40% times $570,000, so we can amortize $228,000, or under the straight line method, we'd get $142,000. Which method would be used? Well, we'd use the percentage of revenue because that gives you the higher amortization expense. And that concludes Part 3 for Chapter 10. If you have any questions, just email me.